There's something I deal with a lot on the stream, and anyone who follows me for a while knows I have a fairly vocal contingent on occasion of, I wouldn't say they're haters, although I definitely have plenty of those, but I have people who don't sort of understand some of the stuff I talk about. And maybe that's my fault, maybe it's not, but I want to talk about MOC for a minute and the market on close reading before we get started here. I think there's the issue happens because people don't really understand how it's used. And when I talk about market on close, if it's, X amount to buy or X amount to sell, it doesn't mean that it should be necessarily gamed to the point where you're like playing long or short versus the MOC. All MOC is it's one type of order, and it's usually large institutions with market on close or basically market on close orders, either to buy or sell large blocks of stock, and that imbalance is the MOC imbalance. Now, it has been to the sell side for months and months, which I talked about, and that was one of the reasons why I've been a little bit more cautious and bearish on the market in general. It's not to be gamed, I don't believe, day to day. How I do use it day to day is if, for example, I'm in a long or a short trade, and I know that the huge institutions are loaded up to sell. If I'm long, I might be looking to trim my longs a little bit quicker into the close before all that volume comes into the sell side from large institutions. The same thing if the market's up, per se, I'm long, and I know there's going to be a lot of institutional orders to the buy side, I might, roll the dice a little bit longer before I close out a intraday trade, or if I'm even just looking to close a swing trade. If you're closing any trade intraday, I mean, you're basically using the same tools as a day trader. So I want to clear that up, that I don't believe MOC is necessarily something you can play long or short against intraday. In and to itself, it's one component that kind of goes into the amalgam of buying and selling, but it's an important one, I think. I mean, if you have a lot of big money looking to either unload or to load up, it can help. It can help you to kind of make a more educated decision. Anyhow, now that we got that housekeeping out of the way, I think that cleared it up. If there's any more questions about that, you can ask me on my Twitter handle. That's @JustinPulitzer. Yeah, the MOC, someone just typed in the room, the MOC did move a lot today, and this was not only a monthly expiration, but it was also a quarterly expiration, so there's a lot of volume and position squaring that go into that. In my experience, there's usually a little bit of hangover after options expiration, so next week, at least early on, could be a little bit lower. If it's not, it may catch some people off guard with their shorts. I had also discussed that I saw today a put wall in the 195 SPY puts, and that I thought that would hold into the close, and it did. I see a lot of people on the stream, they're big proponents of posting open interests, and they like to talk a big game, but the truth is that in a regular uptrending bull market, that kind of stuff is very I guess it's useful to the more novice traders, but when markets get a little bit more choppy, you need a true professional to interpret that. And I believe that it can be very useful, particularly on big expirations. Yes, open interest is important, but the context and also I would say sort of there are some more nuances to it when the market gets a little bit quicker and slippery. So I'm glad that worked out today. There were a few things that were a little bit different than the 824 expiration, which we all know was down, and we know that the following Monday was the flash crash, and I'm just on a bit of a bigger screen. I got a larger computer, so I'm sorry if I'm bending my head a little bit more than usual. I was just looking at some tickers here. There was something that was a little bit different. We did have the flush. It broke through some strikes. And you also had a VIX that closed 25 plus. We didn't close 25 plus today, so that should be a little bit of relief for the weekend, so to speak. If we did close 25 plus, particularly on a huge spike into a Friday expiration, I would say that the odds of a very large down Monday open are exponentially increased. The VIX did close a little bit, toward the higher end of the range, although it did kind of back off right at the close. It topped out just shy of 24. I would say that anything, we had a move lower this week, yesterday actually, after the Fed. It held kind of the borderline support in the 17s, the higher 17s. I've been discussing 1785 and 1757, and we bottomed at 1787, so it was pretty close. And then we rallied up, and today I believe we did close over 22. I just want to see what that final print was. Yeah, we closed over 22. So as long as the VIX is closing 22 or above, it's still a really cautionary level, in my opinion, with regard to the markets. There could still be some more downside. When people on TV talk about volatility, what they really mean is down. That's just how it is. We have had some pretty violent moves both up and down, however, in this market. And if you want to talk about SPY for a second, let me take a look. I usually use the 9-month dailies. If you take a look at what the SPY has been doing, it's been forming a bit of a bear flag. I know a lot of people were in there chasing a lot of stocks this week into the Fed. We had a big run-up into the Fed. A lot of what I affectionately refer to as the silliness found some legs again. That's the GoPros, the Ambarellas, and the Mobileye type of stocks. Some of those I think are going to be in single digits at some point, but that's another story. Not to get too sidetracked with that, but those stocks, are bull market stocks. They are not going to perform well in bear markets. Yes, they can have very violent bounces, but in the end, the trend is down. So a lot of these checked back to some support. I had said in the weekend video on Sunday that it was probably time to look to cover some of those and not to be pressing lows. Amateurs press lows after big declines. That's the same as chasing, like buying highs, looking for still higher after large moves already. It's the opposite. Chasing can happen in both ways, believe it or not. You could have short chasers, and you could have long chasers. This week we happened to have a lot of both, actually. There were a lot of people, I think, who had chased the shorts late last week, and then they kind of got their clocks clean this week. A lot of the people who had puked that dump were chasing the longs. I saw it on the stream. I don't like calling people out, but I have a fade list. I haven't really talked about it that much lately, but I have a list of people who pretty much do it wrong all the time. And when they're long, I like to be short, and when they're short, I like to be long. That's just sort of how it works out. Not any one in particular, but when I see like a lot of them all kind of piling in, particularly on one trade, like all of them were hopped up on Ambarella at the exact top, that is not, that winds up to be the fade. So we did rally into the Fed. The market had been up multiple days, and I had said that they had rich closes, meaning we closed away from the volume-weighted average price, which I referred to on the stream as VWAP, which is the sort of the fairest price to do business, where most of the volume went off, the amalgam of all the trades. And initially, someone had asked me about what I thought the market would do, and I responded that I thought that the risk-reward was changing because we had rallied into the market. I expected it to kind of pop, and then there would be some type of a flop. I didn't anticipate it flopping, per se, the same day. So it was right. It happened even faster than I had thought. I thought it might happen the next day or maybe next week. But we did get a pop and flop. We had a very large topping tail, reversal bar. I'm just looking at it here. The top of the SPY ended at 202s, which really should have been, that had been an old reference high, 201.92 in SPY. That was sort of a breakout level. There was a lot of talk that we would get to the 204s, which is really where the big breakdown was, and we didn't even get there. That should show you just how weak this tape has been, that we couldn't even check back fully there. I think that was also the 50-day moving average. And a lot of people, I think, were playing and chasing long, as opposed to taking down their taking down their exposure. However, if you looked at yesterday, part of the reason I think we sold off was a lot of people were noticing those ever famous MOC orders. They were showing, as the market was rallying, $1 billion to sell. This was because large institutions, the quote-unquote smart money, just so you know, I don't think there is anything such as smart money. I think it's all just dumb money, and it's just degrees of dumb. That's another story. They were all looking to unload. It was taking down value at risk. It's known as VAR. Large institutions have risk desks. And I think that because of the big flush we had, a lot of them kind of got caught and didn't have a chance. A lot of them for sure got margined out. A ton of retail got stopped out. I would say a lot of institutions probably did as well, but I think the big funds didn't have chances to liquidate, and they were waiting for a rally to sell into strength. And that's what they got. They got their gift. They didn't get to take down some of their value at risk, and they took the opportunity to close out. There were probably also a lot of people who had played long for the bounce, and they got their opportunity into a big market to sell. True professionals don't try to catch the exact top tick. They don't try to buy the exact low tick. They realize that it's important to know to buy and sell at the right time, not at the exact top or bottom prices. And I believe that that rally facilitated that type of a sale. You also this week had an options expiration, a quarterly expiration, and retail likes to let options expire worthless, or they like to try and catch the last couple of ounces, but true professionals do not, and I believe that they took the opportunity to close out ahead of the end of quarter. So that is my take on what happened this week in terms of price action, why we rallied. It was a lot of short covering and a lot of chasers, a lot of weak-hand retail chasers, and then the professionals came in and they sold it. And you had algorithms as well that exacerbated that down move. So what happened today? We had the SPY had its its dividend, go ex dividend. So shorts knew they didn't have to pay that dividend, so they can now load up again. They also knew that they would sort of have the selling pressure wind at their backs. That's sort of how expirations have been lately. And you also are going into a weekend. Everyone has been nervous, right, going into the weekends. God forbid, they were to be long, and then have a Monday open up down 1,000 points. There's a lot of psychology that goes into the stock market. There's a really good book that was written in the early 1900s by Selden. It's called Psychology of the Stock Market. If you haven't read it, I would 100% support reading it. And there's a phenomenon known as recency. And people perceive recent events as more likely to happen. Like if you have a data set of 100 coins being flipped, and sometimes you'll get some subsets. You'll get let's say you have 10 in a row or 15 in a row of heads. People always assume that the next coin flip is as likely to be heads as it more likely to be heads than tails, just because the last few data sets have shown that. But as we all know, over a long enough period of time, you flip a coin 100 times, roughly half will be heads, roughly half will be tails, given the fact that there can be periods of time where it doesn't work that way. But in the longer run, that is how it is, and that's really how to think. Anyhow, I don't want to get too wonky with statistical analysis here, but psychology does play into effect. Recency is a psychological thing, and gaming crowd behavior is very much part of the game. That's just sort of how it is, and that's why I always think human beings have edges over algorithms. Algorithms are really good at making cold, hard decisions based on levels, but human beings are better at sort of interpreting the extremes. Anyhow, let's talk Fed. I've created a hashtag, and it's become very popular in the mainstream media. Many of you may have heard of it. It's called Lower for Longer. And it's become very popular. It's talked about. It's never accredited to me, of course, because the media is terrified that social media is displacing them. They're all still functioning on broken 1990s models. And instead of having, fancy Nortel commercials paying the bills these days, these guys are selling headlight cleaner, restorer. I assure you the ad revenue they're making now is very different than it was then. and they are terrified. Anyway, the consensus groupthink was that we were going to see a rate hike, correct? That was the big fear. And you had a lot of TV personalities. I don't want to get into anyone specifically, but if you follow my stream, you probably know whose case I've been on about this. We're saying that they originally thought that the Fed was going to raise rates. There was a lot of fear created about this, I think very unnecessarily. I believe that the Fed did a very good job of making people believe that they wanted to raise rates. And maybe they do. The truth is, I think academics are very offended the fact that interest rates are staying so low, so long. And if you look at a historical analysis of interest rates, we are well below the average for of thousands of years worth of interest rates. Believe it or not, it's actually pretty crazy. I've seen some pretty wonky studies on this stuff. But the truth is that interest rates on the long end of the curve, meaning the 10-year, 20, and 30-year bonds, can really only be raised not by the Fed. The Fed is really good at controlling the short end of the curve, meaning 2- and 3-month securities. But if there was true money demand for higher, the Fed couldn't hold it back for long. So the truth is there's not a lot of demand for longer-term money. A lot of that, I believe, is because of uncertainty that is taking place globally, and I'm going to get into that in a minute. But I want to cover fiscal policy for a brief bit. You have Obamacare, you have a lot of uncertainty with financial regulations and EPA regulations, and the highest corporate tax rate in the entire world, bar no other country. So companies have been reluctant to invest in their businesses. You might see a lot of companies are doing layoffs. Companies will likely, and I'm sorry whether you like this or not, but companies will do rounds of layoffs before they cut their dividends or their executive compensations. I know it's terrible and we could rally against this, but this is the real world. This is how it works. And I believe the Fed was acutely aware of this. But companies, because they haven't had visibility in their future earnings, are basically thinking very short term. They're looking to get their stock prices higher. They are buying back stock at a record pace, which has fueled the rally in the stock market. We all know that retail has not come back to the degree that it was, just a few years ago. I will caveat that and admit to the stipulation that options volumes are up huge. A lot of people are playing in options these days. I think a lot of people, and just by some of the questions I get, don't really truly fully understand options, but they are playing them nonetheless. That volume probably has offset some of the amount of retail, but I will tell you, I live in New York City. I take taxi cabs, Uber more lately though, because I'm fancy like that, and even go to the dentist. They don't care about stocks. No cabbie is telling me to buy Sirius satellite radio. My dentist isn't talking to me about buying, tech stocks like they were in the dot-com days. I used to get really nervous in the chair that my dentist was more worried about how Cisco and AOL were trading than handling, a filling or whatever. That isn't happening today. My friends don't really talk to me about stocks for the most part, with a few exceptions. It's sort of become taboo. A lot of people were burned in the 2000s and again in 2008 and 9. And you can see just by the fear on the stream that every time we have a down move of like a 5% correction, everyone immediately thinks it's 2008 and 9 again. And yes, what's going on is China is very serious. It's a massive deflationary event, and I'm really glad that Janet Yellen had her maverick movement, and I was talking about this the other day, where she basically finally told the markets, I'm going to raise when I'm goddamn good and ready. You got that? I mean, it was just ridiculous that the media thought that they could bully the Fed into raising interest rates. What's coming out of Asia is massively deflationary. The Chinese are devaluing their currency at a record rate. The Europeans are doing the same. These are all major export economies. We have a trade deficit here that is huge. We have a dollar that's already strong. If the Fed were to have raised interest rates, that would be like taking a bottle of lighter fluid and shooting it onto a barbecue. The dollar would have exploded higher, and you think we were down a lot the last 2 days. We would have been down so big you wouldn't even believe it if the Fed had raised interest rates. So bravo to Janet Yellen. The lower for longer thesis played out. I don't really want to get too into detail about what that is. I've talked about it ad infinitum. I've written articles about it. If you are watching this now and you want to see that article, I will post it again to my Twitter stream a little later. That handle is @JustinPulitzer. If you're coming in late to this broadcast, you can see it repeated on my YouTube channel at Justin Pulitzer Trades. I will post that there, as well as a link in this description below. We're not done, don't worry. We got a lot to discuss. I have tons more I wouldn't say tons, but I have a little bit more I want to go over, and we'll wrap up in about, like, let's say 10 minutes or so. Anyway, I want to just go through a little bit of what the Fed release said and why I think, and my updated thesis to lower for longer. The same intelligentsia that was saying that they should raise in September are now kind of still thinking the Fed is going to raise this year, and they're looking to October or December. This is redonkulous to me. You were wrong. You know, it wasn't a 50-50 bet that the Fed was going to raise rates. If you looked at the bonds, the Fed futures, it was like 70-30. So it really pisses me off when you see people come on TV and say it was a coin flip. It really wasn't. It was sort of, everyone already kind of knew that anyone who can look at numbers knew that the Fed was likely not going to raise. And if you look at some statistics and some of the stuff I've talked about on previous broadcasts, it was very obvious that the Fed wasn't going to raise rates. You know, some people were saying, oh, you thought I were going to waver, and, you know, I wasn't going to stick to my guns, and then I would cave and say that I thought that the Fed was going to, I'd punt. But no, my answer to that was that I thought that the Fed was just trying to use moral suasion to talk the markets down. And I had said in a tweet that got a lot of favorites and retweets that I think that Fed is still playing with fire. Although I think that they calmed that down a little bit. I think that the sell-off, like I said, the last couple of days were just a lot of chasers who had gotten long. We had gotten away from value, and this is sort of just correcting that and going into the expiration. I'm not really reading more into that until just yet. But I think that the Fed is playing a little bit of a dangerous game because they might be trying to orchestrate some type of a controlled correction. And to me, and I said this on Twitter, is that's sort of like thinking Jurassic Park is safe. You know, eventually the dinosaurs get loose and eat everybody. So if you are trying to orchestrate a down move, it can easily get out of control, and you can turn what should have been, you know, sort of like an afternoon shower into a full-on hurricane. So, you know, when the roofs are getting ripped off, you know, that's what interest rates, I think, would have done. What do I read into not holding the rally? I just read into it that people chased. You had a lot of short covering into this. You had a lot of really weak hand chasers chasing the silliness, like I refer to. They were bidding stuff up that really had no business to be bid up yet. The bear market in stocks is definitely not over. Like I said, I don't countenance pressing lows, but, you know, rallies in. All right. So when a market is trending up, you buy the dips. When a market is trending down, you sell the rips. There we go. BTD, STR. That's sort of the way it goes. And, you know, I don't know that we're in a full-on bear market yet, but, you know, I call opening up 1,000 points lower and, you know, not being able to rally up, you know, even to have a retest is still rather weak. Cash is always king, by the way, no matter what anyone tells you. Don't let anyone ever tell you having cash isn't king. One of the big mistakes, and I'm sorry, I don't want to get too sidetracked on this, though, but this is probably really relevant to a lot of you, so I really don't mind discussing this. You know, and I have to admit, I was a victim of this in my youth. If you have if you have a smaller trading account, everyone always wants to be Carl Icahn overnight. They want to take a $10,000 account and make it a $20,000 account. If you want to have a $50,000 account, you want to make it a $75,000 or $100,000 account. And the best way to do that is to be in the market, right? To be invested full on all the time. This is an absolute rookie mistake that will not only not get you there, it'll set you back a huge amount, and it will probably wind up blowing out your account if you're not, managing risk. And if you're already at max margin and you're already fully invested, you are already making risk management mistakes, and my guess is you're not going to take small losses. You probably have way too many positions on in way too large of a size than you really understand. The geometric series, Google that. I don't want to get into a full-on stats discussion. I think I've already done enough of that today. Works in both ways, and we all know that people are more cautious buying. They're particular about hitting the buy button, every penny, every half a cent, quarter, they're particular about. When the market is plummeting lower at points at a time, people just hit the sell button. Get me out. GTFO. Get the F out. And I think that the big difference between professionals and amateurs, or at least the experienced, the initiated, and the uninitiated, is that taking losses is fine. I take them all the time, regularly actually. I like to keep them small. That's the key. Letting the winners run and letting the losers go. How do you know when you should keep a position if it has a small loss and when it doesn't? This is something I see on the stream all the time, and it's very easy to say, oh, take the small loss, it's the easy loss. It's the hardest loss to take. The big ones are the easy ones because you're in so much pain. When you've had a loss where you can feel your lowards in your throat, it's an easy decision to panic and hit the sell button. But if you're only down 1% or so, maybe it's not. Maybe, it'll come back, the hope and pray game. The only time I will not take a quick loss is if my thesis for the reason for the security or whatever I'm in to go the direction I think it will go in, if that is not broken. So here's the answer. If you have a set level, a trend line, or a Fibonacci level you're playing against, honor your stop. It's right or right out. I always say this, row. That means right or right out. It means the trade is either right or you get right out. You don't play the I'll see what happens on Monday game. If you're buying Apple and your thesis is that it's going to hold 115, that's a key level. The minute it breaks that, you get out. I mean, it doesn't necessarily have to be, that, you want to be picked off with your stop run. If the stock goes more than 15 cents against you or whatever there, you can get out. You could always get back in. It's just a commission trade. I mean, it's annoying. I've had it happen a bunch of times, but that's the truth. The 15 cents or whatever that, your give isn't going to be the dollars it costs you when the thing collapses and falls out of bed like it did. It closed at 113.45. So you saved yourself over $1.50. Actually, if you follow my stream, I said yesterday that it was a short below 115. If you took that, you're happy. Anyway, the hope and pray game is not relevant, in my opinion, to Wall Street. And if you, it makes you a good person in real life. And that's, I think, the reason that so many people don't do well in trading is that they equate what makes them good people in their lives to how to trade stocks. They believe in a stock, and they don't take the warning signs. Like if you use a GoPro, for example, you might be a big fan of the product, but the truth is, and I'm sorry to pick on this stock, but I will go on record and say that I hate the stock, I hate the management, I hate the company, I hate the product, I hate that they unlocked their shares ahead of time for some charitable whatever. I think it's the next flip camera. Which we all know was a zero. Cisco bought it for $600 million and it went out of business. And I see a lot of people on the stream saying, oh, don't worry, Google will buy them. The company is trading 25 times earnings with a product. I mean, how many people are going to duct tape a GoPro on the front of their mountain bike and film themselves jumping off of a cliff? That number is finite. It's not like an iPhone, for example, where people, it's a staple. Like I believe smartphones at this point are like toilet paper, frankly. I think that people need it, and every couple of years, you jam it in your pocket, you jam it in your bag. I can't even tell you how many people I know have cracked screen iPhones. They're always waiting for their upgrade. That is a product that will refresh. Even iPhones, believe it or not, at some point will tap out. A lot of people are worried about the quarter here. Um, someone asked about Apple. So here's my thesis on Apple. I think that we need to look and see how, I don't know if they reported yet, Nike. I'm curious to see how Nike did. I know Apple wrote Kramer on his show, and Tim Cook had said that iPhone sales were okay and that they were actually accelerating. I actually believe Cook. I think that iPhone sales are doing fine, but you're in a blackout period here where the company can't really discuss any of this because of earnings. And you'll see a lot of rumors floated by the bears. I saw a few people today saying that the iPhone is still available. You can still get the launch iPhone. Yeah, that's a little disturbing. I will say this though: I do a lot of homework on Apple. I have some sources sort of at Apple that I tap. I ask people. I go to the store. I ask people who have been reliable for me in the past. And they say that the watch adoption rate is about the same as the original iPad, which I think is good. I'm starting to see more of them. I think a lot of people are, though, like myself, and people I've spoken to are waiting for the second generation for them to work out the kinks. I do believe that I read tech blogs. Apple did a record build for the new iPhone. They created 90 million iPhones. That'll eventually translate well into their suppliers, I think, on their quarters. But if you look at their charts, they're terrible. I actually shorted Intel yesterday near the highs. I put on a put spread. That's another story. I think that's already doing me well. Let me take a look. I didn't even have a chance to check Intel today. Yep, down pretty big today. Held the 50-day moving average, though. I'll probably use, if it gets back up over 29.65, I'll start reevaluating the trade, 29.65 to $30. It shouldn't really see that again. Anyway, sorry to get sidetracked, but I do believe that Apple will probably have an okay quarter. I want to see the stock down into the quarter, though. I'd like the IV to jack up so I can sell some out of the money puts or do some put ratios or do something, buy the stock and sell calls to hedge or whatever. I will say this. I gave you my opinion on the company, and now I'll give you the technical analysis of it. And the technical analysis is the one that you should use. So it lost 115, which is a really key level. A while back, there had been another flash crash in Apple, and that was the low. So that's really important. It didn't get up to the 50-day moving average. It was so weak it couldn't even get there. It is, however, above the 20-day moving average. Excuse me. So if you're long Apple and you want to try and keep it long, I would use the 20-day moving average is your stop. I think it's roughly around the 111s. I would also use the 20 MA as a buy point if you want to try row. So like if it gapped down and it's not like a disaster on Monday, and it gaps down gently there, you might want to try it for a row. Hey, how are you? Thank you for logging in. I appreciate it. If you just logged in now, like I said earlier, there'll be a rebroadcast on my YouTube channel. Anyway, I believe that Apple below 115, though, could see the 20-day moving average. If that doesn't hold for that right out play, and the 20 MA has been a little less important for Apple now that it's split. It was very important, and particularly when it was kind of bulling. In an uptrend, the 20 MA pre-split used to be the buy, and if it held it, it was strong. If it broke, it was really signaling trouble. Below 115, though, I believe 109s are in play. If it loses 109, the 103.74 and then the 100.72 is in play. Apple on the flash crash did get the 92s. I had said that I thought that 95 and 85 were potentials. Those are the 50 and 61.8 big Fibonacci retracements. I do believe if there's a bigger market sell-off, it could re-see those levels. I would use those for row or to sell out of the money puts into. If Apple is weak and IV gets jacked, you can use the increased volatility to sell out of the money puts or to play put ratios. I really like, but you have to. The beauty of the put ratio is that it is a directional play for a controlled move that should be put on in the direction you're playing in, because you're technically your net short premium. I often talk about put ratios. I've done 1/3s, but for the most part I do 1/2s. I usually do it in the same week or the following week, where I'll buy, like for example with Apple, an example of a put ratio would be to buy 105 puts and to sell 2 times as many 100 puts. So that would be, you'd be looking for the stock to come basically down as close to 100 as possible. You do have a little bit of protection if it goes through there. I don't want to get into the exact math of all of these, but it'll give you something to figure out. So that's how I would be playing it. If Apple came down lower, I'd be looking to buy put ratios. I think those will work out really well for that stock. I also have been playing them in Netflix. A lot of them zeroed. I had a pretty good amount of them on for this week. Unfortunately, Netflix bounced a little bit ahead of where I thought it should. I did think that it was possible that it could get back up to the 50-day. It didn't even get there. Basically, Netflix, in my opinion, is a head and shoulders breakdown. And this week's rally was just sort of the check back to the breakdown. It got a little bit above the neckline, which was 103.88 to 105. It squeezed a little to 107s. But if you take a look where it closed today, we're well below there. So on weakness next week, I would be looking to play put ratios. And I'll tell you, if Netflix loses that 93.61, I think it's like 93s. It's an outright short because that was the kind of the last swing low. I think you would see the 85s, the 90s and 85s in that baby really quickly. I've been working on the thesis. It may take a while to get there. It may not even get there. But Netflix really broke out from 69.90. Let's just call that 70. It would be really healthy and an amazing opportunity if it went back and rechecked that level. Let's see how that goes. If it got there, I would be a buyer in size. I might even do risk reversals where I sell puts and buy calls, or buy call spreads. Or sometimes I'll break it off where I'll sell the puts, I'll buy the calls, and then wait for the rally to sell the calls. These are all sort of ways to play this. You could even buy the stock. I think that level would be a fantastic opportunity. I don't know that it's going to get there. It could just zoom back up. If it gets back up over, believe it or not, the 107s, you're probably going to see the 110s, and maybe the gap fills to the 115s. If you want to play long, guess what? We can do that with ratios too. I suggested buying the 109s, 110s, and I think it was selling the 113s. Unfortunately, that didn't work out. It didn't get up there this week. But you can play that again, and I believe the break even on that was like somewhere between it was up near the highs, I think near 117, right? Yeah, it was right up near the upper right shoulder. If we do break that 117, by the way, just GTFO, if you're trying to play short and just outright long, it's going to see the new highs and probably new highs on a squeeze. Failed head and shoulders patterns are huge longs to the upside. That really actually kind of played out a little bit in not Netflix, in Priceline. Once you took out the right shoulder high over the 1264.98, I discussed this on the stream. One of my followers actually had discussed this with me. She is a smart cookie. I really hope she was on the right side of this, but I had discussed on the 9/8 that the stock was a professional gap. It was a gap and go over the head and shoulders. Anyone who was short looking for that breakdown was wrong. The next day it was up, but kind of finished weak, but then after that really took off, and it did test well into the head. It actually got a little bit into the gap day, and it reversed the last couple days just on market weakness. I would say this, though, the only time I would be interested in shorting Priceline is if it took out the 1280 to 1281 area. If it breaks there, I would say it'll see the 50 MA and could even fill the gap pretty quickly down to the 1245. So that, to me, would be a row short opportunity. You could play that with shares if you want. You could play if it breaks that up. Absolutely, I would be looking to play the short. You can sell out of the money call spreads. Your IV will be going the way you want it, or you could do put ratios or put spreads, or there's so many ways to skin a cat. So, or do short a stock. So that's the way I would play it. Do we want to go over? I'll leave it to you guys just by yes or no. Do you want me to go over the Fed specifics about what they were looking at and why I don't think they're going to raise this year, or do you think we covered the Fed enough? Just type in the box yes or no, and I'll do a quick tally. No. Yes. Yes. Just yes or no's for these. A few more. It's about even. No. No. All right. You know what? I'll tell you what. Let's, since we're a little late on time here and there's some more stocks we want to cover, how about we split the difference and I covered a little bit in the weekend review. And that would be up on Sunday. So let's do that. All right. So let's cover some more stocks. I covered Netflix. Let's talk about Facebook. That's been showing a lot of relative strength. I think it has run a lot here. You can play right or right out against the 50-day moving average. I would be, if you're long, 92.54, I think is your stop. That was the, let's just say the 50 MA. Let's just use the 50 MA. Wherever that is at the time, use that as your stop. Or if you want to buy that right or right out. I would be looking for some type of a pullback here because I'm a little bit worried about the market in general. I do think Netflix is, not Netflix, I do think Facebook is going to make new all-time highs, 100 or higher. It does need a little bit of market cooperation, so I would say that that's a good buy the dip stock. Twitter, so let's talk about Twitter. I am long a little bit of Twitter. I do believe you can play long here against this sort of like 2642 reference low. It looks like it's trying to form some kind of like cockeyed inverse head and shoulders here. What a piece of crap, right? This company is. They have a terrible management team. They have not been able to monetize this product. Someone was asking me on the stream today, what do I think about Twitter and their prospects with the new CEO? I don't really think the CEO matters. I think the issue is that they need to show growth. They still have a growth valuation. Let me see, what are they trading? I don't have to worry about looking at forward multiples because they have no growth, right? I believe that they had a pretty good quarter numbers wise, but they're not only not gaining users, they're kind of losing them, or it's just like a push. It's hard to have growth valuations if you're not growing. It's also hard for companies like Google to want to buy you and still spend $12 billion or whatever they're worth if your company doesn't have growth. These companies want to buy growth. I do believe that if someone else bought them, like a Google or a Facebook, I do believe that they would fix their growth problem rather quickly. They'd probably do a better job of monetizing. These guys are basically running a clown car over there at Twitter. It's crazy. We love the service, right? But we just need them to really make it easier to use. I was talking to a friend of mine, incidentally, the other night at a bar, and she's just like, I never use Twitter. I don't even know how to use that thing. Like, what's the purpose of Twitter? But she uses Facebook and Instagram. My fix for Twitter would be for them to make themselves a little bit more Instagram-alike, actually, not more Facebook-like. Anyway, that's my two-bit on Twitter. I am a little bit long. I'm cautious with it. I think that the stock can rally to some degree. There'll probably be some buyout rumor that spikes the stock at some point, and then you can just sell into that like you do with every one of them. They have a lot to prove. Oil. So, sorry to jump back between macro and this stuff. Oil today, it had broken out 2 days ago. It had closed above the 50-day. Today it took out it closed us below the 50. I think oil is trying to be in a bottoming process. I think somewhere between 33.20 and 37 should be the low. Should be. I don't know that we're not going to have to retest it. We're sort of just in like a bull flag pennant here. It kind of held the 20 just below the 50. You really need to see this kind of make a higher high at this point, which would be over the 49.33. So I am cautiously optimistic with oil. I've been sort of slowly buying some of the oil and some of the commodity stocks, really, really small size, because it is a little bit of bottom fishing, I would say. These are for longer-term type of accounts, just on the thesis that they can't all go to zero, like the BTUs and the Freeport-McMorans and stuff. I do believe that at some point oil will see 75 again. It's just a matter of if it's going to see lower or higher first. I think a lot of companies have hedged out their oil exposures in forwards and futures, probably closer to in the 50s. So that might put a little bit of a high cap on oil for a bit. So someone had asked me on the stream earlier, are we Japan? So I figured I'd save that for the oil trade. The answer is that we do have a lot of similarities to Japan, but we do have some really remarkable differences. Japan is an export economy. We are a service industry economy. I've discussed this with waiters and waitresses and bartenders, although our Apple technology is starting to eclipse a lot of the stuff in the world, even Microsoft to that extent. How many people do you know that have Sony TVs now? It's all Samsung. I have 2 Samsung TVs in my apartment. Years ago, I probably would have had a Sony. So it's shifting a little bit to Korea as opposed to Japan. Japan also doesn't have natural resources like we do. We are very rich in terms of natural gas, coal, and oil. Japan is very largely dependent on oil. They need to import. That's actually one of the reasons for World War II. We started embargoing Japan and strangling their oil, and they didn't like it. So that was part of the issue. One of the things we do have in common is we're not quite as bad as Japan just yet, but our population is graying, and we are putting more and more resources toward our elderly and old via healthcare and via entitlements. That is what's crippled Japan for a while. Japan also, during their financial meltdown in the 80s, didn't take the kind of write-downs that they needed to. China still hasn't. There's a lot of zombie companies in China. I'll reserve that for another time since we're running low on time and I want to wrap up in 2 minutes. But they didn't take a lot of their write-downs, and I think they've sort of just been a zombie economy for a while for those factors. So I think that covers it. Let's end on... someone had asked about FireEye. I know that gets a lot of discussion on the stream. So FireEye is sort of bear flagging. It's still making lower lows and lower highs. It's kind of in a compression area right here, right on the 61.8 fib. It's 36.47 is that fib. If you're long, I would say you could use those reference lows just below, kind of like those 36s as your stop. That was also sort of like the close on the flash crash days. So if you lose 36s, I think you're going to have some trouble. It is sort of forming a bit of a pennant. If you can start making some higher highs, I would say that you could get to maybe the downtrend line in the 200 MA around 41s. Maybe it would even squeeze up to 42s. But these stocks have been really not acting well. Palo Alto is another one not acting really particularly well. CyberArk not acting particularly well. I would just be cautious with these. I had been long FireEye for a while, and I sold it into the rise. It didn't turn out to be the exact top, but it was definitely a lot higher than it is now. Someone just asked about Tesla. The answer with Tesla is I think it's going to go higher. I would say that if you're long, you have to use 242. That was the secondary price as your stop. That was where Elon Musk bought in. If it gets below there, it gets iffy. Anything above there to me is still good. It got into sort of the upper distribution, had some reference selling. I would be looking to kind of reload and kind of BTD right on the 50-day moving average, 100-day moving average confluence, wherever that turns out to be. So I would say it's still a buy the dip stock. It's amazing that this is held up as well as it has with oil and gasoline prices coming down. I just think they have a lot of product cycles in their favor. So Tesla, as long as it still holds, again, don't chase the highs. Buy dips, particularly on this tape, but as long as it's holding 242, I mean, it's okay. Below there, a little bit iffy, and you could start playing some put spreads or ratios for play down to 225s and maybe even 205s. Like if it starts losing that area, I'd be like looking to buy maybe 225 puts and selling 205s 2 times or 3 times against it as like a put ratio. Anyway, let's have a good weekend. I hope you guys found this video informative. If you're not following me, you could follow me on Twitter. My handle is @JustinPulitzer. I have a YouTube channel. If you caught this sort of partway through it or just want to watch it again, can't get enough. It's at Justin Pulitzer, or I should say it's just Justin Pulitzer Trades on YouTube. If you hit the subscribe button there, you get a few things. You get notifications when new videos go up. You get for both weekend review videos, which is sort of like the big boy version. This is sort of like weekend review light. And follow-up, you also get the rebroadcast of the Twitter show as well as special edition videos. I haven't done a lot of those in a while, but I will be doing some soon. Anyway, let's have a good weekend, and cheers.